Hello everyone, I'm Yali Jiang, and today I want to talk about something that unfolded in the precious metals market this morning that I think deserves far more attention than it's currently getting. Silver futures on the MCX just jumped Rs 4,500 per kilogram in a single session. Gold rebounded. And here's the part that should make you stop and think. This happened while geopolitical tensions were actually easing. US-Iran talks in Geneva showed progress. Safe haven demand was supposed to fall, and yet silver surged. That contradiction is not noise. That is a signal. And by the end of this video, I want you to understand exactly what it means for your portfolio, your strategy, and your thinking about precious metals going forward. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through the numbers because the surface level story and the deeper story are two very different things. On Wednesday morning, MCX silver futures for March 5th, 2026 delivery gained Rs 4,556, or roughly 2%, bringing the price to Rs 2,33,339 per kilogram. MCX gold futures for April 2026 rose Rs 1,885, or 1.2%, to Rs 1,53,303 per 10 grams. In the international market, gold edged slightly lower, around $4,167 per ounce, while silver dipped marginally to about $70.30 per ounce. So we have a divergence. Domestic futures rising, while international spot prices softened. That gap matters. It tells us something about local demand dynamics, currency effects, and the way Indian investors are positioning themselves relative to global sentiment. Now, the conventional explanation goes like this. US-Iran talks ease tensions. Safe haven demand drops. Gold and silver should fall. And in the international spot market, they did, modestly. But on MCX, both opened higher. Analysts at ANZ noted that a firmer US dollar weighed on gold, while lower US Treasury yields provided only limited support. Trading across Asia remained subdued. So why did Indian futures defy that gravity? Part of the answer is the rupee. When the dollar strengthens, it typically pressures commodity prices denominated in dollars. But for Indian investors buying in rupees, a stronger dollar means a weaker rupee, which means the rupee cost of imported commodities rises even when dollar prices fall. That mechanical relationship partially explains the MCX premium today, but it doesn't explain all of it, and it certainly doesn't explain the scale of silver's move relative to gold. Look closely at this trend. Silver outperformed gold today by a meaningful margin on a percentage basis. That's not random. It reflects a growing bifurcation in how the market perceives these two metals. Gold remains primarily a monetary asset, a store of value, a hedge against uncertainty, a safe haven. Silver is all of that, but it's also something else. Silver is an industrial metal, and that industrial identity is becoming increasingly dominant in the way silver prices behave. Let me give you the structural picture, because this is where the story becomes genuinely important. Global silver demand has been running at record or near record levels for several consecutive years. The primary driver is green energy infrastructure. Solar photovoltaic panels require silver. Each panel uses a small but meaningful amount of silver paste for its electrical conductivity. As the world installs more solar capacity, and the scale of that installation is enormous, running into hundreds of gigawatts annually, the cumulative demand for silver keeps climbing. This isn't speculative, it's engineering. It's built into the physics of how these panels work. And no cost-effective substitute has displaced silver in this application at industrial scale. Now notice what changed in recent years. The solar build-out accelerated dramatically. China's domestic solar installation program, combined with aggressive expansion across Southeast Asia, India, Europe, and the Americas, has driven silver offtake higher in ways that were not fully priced into the market even 2 or 3 years ago. The Silver Institute has documented consecutive years of structural supply deficits, where total demand exceeds total mine supply plus recycling. When you run deficits year after year in any commodity, you draw down existing inventory. Eventually, inventory gets tight. And when inventory gets tight, price sensitivity to any incremental demand surge becomes acute. Let me walk you through the supply side, because this is where the constraint becomes a pressure point. Silver is not primarily mined as a standalone product. Roughly 70 to 75% of global silver production comes as a byproduct of mining lead, zinc, copper, and gold. That means silver supply is not particularly responsive to silver prices alone. A silver miner cannot easily ramp up production just because silver prices rise if the economics of the base metal they're primarily extracting don't justify increased activity. This inelastic supply structure is fundamentally different from, say, oil, where higher prices can quickly incentivize new drilling. Silver supply is structurally constrained in a way that most commodity investors underestimate. Add to this the fact that several major silver-producing regions have faced permitting delays, environmental challenges, and geopolitical disruptions over the past few years. Mexico, which is the world's largest silver producer, has navigated a complex regulatory environment. Peru, the second largest, has experienced ongoing social conflicts near mining operations. Primary silver mines that were in development have faced timeline slippage. The pipeline of new supply coming online does not offset the pace of demand growth. That gap is the foundation beneath today's price movement. But here's where it becomes important. When we look at ETF flows and institutional positioning in silver, we see a market that has been, until recently, relatively underinvested compared to gold. Gold ETFs attracted massive inflows throughout 2024 and into 2025 as central banks and institutional investors sought inflation protection and dollar alternatives. Silver ETFs saw more modest inflows. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, remained elevated by historical standards for much of that period. A high ratio means silver is cheap relative to gold on a historical basis. And historically, when that ratio begins to compress, it tends to compress rapidly because silver moves faster than gold in percentage terms once institutional and retail money starts rotating into it. This pattern has appeared before. In the late 1970s, in 2011, and in 2020, silver dramatically outperformed gold during periods of sustained precious metals rallies. Each time, the initial phase was dominated by gold. Silver lagged. Then silver caught up and surpassed gold's percentage gains in a compressed time frame. The market structure today has similarities to those prior setups, not identical, but structurally analogous in terms of the gold-silver ratio, the supply deficit backdrop, and the industrial demand tailwind. Now, let's talk about what today's price behavior suggests about something deeper, about inflation, about currency confidence, and about investor psychology. Gold at $4,267 per ounce is not a number that exists in a vacuum. That price is a statement. It is the market's collective judgment about the purchasing power of fiat currencies, the credibility of central bank inflation management, and the reliability of government debt as a store of value. When gold trades at these levels, the market is saying something uncomfortable. It is saying that a meaningful segment of global capital does not fully trust paper promises. That instinct doesn't disappear just because US-Iran tensions ease slightly. Geopolitical risk was never the only reason gold was at these levels. It was one factor among several structural ones. Silver at $73 per ounce carries a similar message, amplified, because silver's industrial demand doesn't care about geopolitics either. The demand for solar panels, electric vehicles, 5G infrastructure, medical devices, all of it continues regardless of diplomatic developments in Geneva. That demand is not sentiment-driven. It is capital expenditure-driven. It is policy-driven. And it is locked in for years by contracts, grid expansion mandates, and energy transition commitments that governments have made and cannot easily reverse without political cost. What this tells us about investment psychology is that the rotation from pure safe haven thinking toward industrial scarcity thinking is underway. Smart money is not just buying silver because it's nervous about the world. Smart money is buying silver because it understands that the world needs silver to function in the way it has planned to function. That is a qualitatively different and more durable thesis. The analyst's recommendation from today's coverage to avoid fresh positions this week and maintain caution given volatility is a reasonable short-term posture. Volatility is real. Momentum chasing in a 2% single-session move without understanding the underlying structure is dangerous. But caution about the near-term entry point is not the same as caution about the long-term thesis. Those are two different conversations, and conflating them is a mistake many retail investors make. Let me bring this together with a summary of where we stand. Silver jumped Rs 45,500 per kilogram today in the face of easing geopolitical tensions. That happened because the forces driving silver are not primarily geopolitical. They are structural. Supply deficits are real and documented. Industrial demand from the energy transition is real and accelerating. The inelastic nature of silver supply is a fundamental constraint. The gold-silver ratio remains historically elevated, suggesting silver has catch-up potential relative to gold. And the domestic MCX premium over international spot prices reflects currency dynamics and local demand that add another layer of support. Silver's role in the global economy is changing. It is no longer simply a monetary relic or a cheaper alternative to gold. It is a critical industrial input in the infrastructure of the 21st century. That shift in identity has long-term implications for how it should be priced, how it should be held in a portfolio, and how investors should think about its risk-reward profile over multi-year horizons. For investors, the actionable insight is this: understand the difference between price and value. Understand the difference between short-term volatility and long-term structural change. And understand that the moments when conventional wisdom says to be cautious are often the moments when the most important structural shifts are quietly consolidating. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize.